What's happening, everybody? In case you forgot, my name is Pete O, and I'm on the go, and I'm about to teach you about a ratio. Let's go. Here we go. You ready? Liquidity and solvency ratios. Don't forget, the purpose of the balance sheet is to do what? To determine financial risk. And that's a key component when you value a company because you need a discount rate when you project future cash flows. Okay, so financial risk, along with operating risk and other sources of risk, is going to help us determine an appropriate required rate of return, a discount rate to apply to future cash flows. Liquidity is all about short-term risk. Are you liquid enough to pay your bills as they become due? And then solvency again looks at the long-term capital structure, the pros and cons of various degrees of debt to equity. All righty, so a liquidity ratio, also a coverage ratio. Again, like we saw earlier, the cash flow coverage is the numerator here, current assets, sufficient to pay the denominator. So remember, the short-term obligations are maturing next year, and failure to pay your debt as it becomes due can render you bankrupt. So as the coverage ratio goes up, the short-term risk of distress goes down. So the numerator, we start with the current ratio. And since both the numerator and the denominator are coming from the balance sheet, no averaging required. We just take the current year assets divided by the current liabilities, okay? So the higher the current ratio, the lower the risk of distress. But the issue is, you're not really comparing apples and apples. It's more like apples to oranges. Why? Because your numerator is not just cash or cash equivalents. You've got receivables, inventory, prepaid. You're assuming that stuff is liquid. And liquid enough to pay your denominator, and all the current liabilities have to be paid in cash. So current ratio is one way of measuring short-term risk. Now, we want to look at our trend. The current year, the ratio is 1.03. Last year, it was 1.09. So the year two current ratio is less than year one. So just looking at that abbreviated information, that abbreviated trend, well, it declined a little bit. So the risk went up a little bit. So we would say it's deteriorating a little bit. It's not significant, but the trend is we would need more information. I would also want to take a look at the company's current year ratio, 1.03, relative to the industry average. Well, the target company is only 1.03, much less than the industry average of 1.5. So this target company is relatively riskier. But folks, that doesn't mean they're going to go bankrupt. They might have a line of credit that they could easily tap into that's not shown on the balance sheet here. It might be in the footnotes. So you can't jump to an immediate conclusion that they're bankrupt, okay? You got to make sure you look at holistically, do they have lines of credit and could they get access to credit if they needed it, etc., okay? But in the abstract, just looking at relative to the industry average, yeah, they're riskier, okay? Now, note something here for me. As current assets go up, relative to non-current assets, yeah, there's no doubt. If you have more cash and marketable securities on your balance sheet, you're going to be less risky. That's the good news. But then there's bad news. You know from having money in a checking account or a savings account, what kind of return do you get when you put your money on the bank? Not much. So when you have a lot of current assets relative to non-current assets, there are pros and cons. The pro is there would be less risk of short-term distress, but the return on asset is likely to be much lower as well. Okay. What's another ratio to look at short-term distress? Sometimes it's called the acid test or the quick ratio. It's more conservative. It's more liquid than the current ratio. Why? Because we're taking two things out of the numerator, inventory and prepaids. It's just your cash, your marketable securities, and your receivables. But we're reducing the numerator by the inventory and the prepaids without touching the denominator. So your quick ratio is almost always going to be less than your current ratio, unless your prepaids and inventory happen to be zero, okay? It's almost always lower than your current ratio. It's more conservative. But again, let's look at our trend here. You ready? The current year, it's 0.61. Last year was 0.7. Well, the higher the ratio, the more you have in the numerator to cover the denominator, the less risk. Well, look, last year we were 0.7. This year we're only 0.61. So it declined. Like the current ratio, it declined. So thus, deteriorating. Looks like risk is going up a little bit. It's not a significant reduction, but, it's, relatively speaking, yeah, 0.7 to 0.61, yeah, we're deteriorating. Well, what about relative to the industry average? Well, we're much lower. 0.61 this year relative to the industry average of 0.8, yeah, we're riskier. All righty, so the cash ratio is more, the quick ratio is more liquid because it excludes the inventory and the prepaids, okay? Now, the most conservative short-term risk metric is what's called the cash ratio because there's only two things in the numerator, cash and marketable securities. So that will always be lower than the quick, assuming you have receivables and what have you, but it's almost always going to be the lowest, followed by the quick, then the current ratio. Now, look, how do you know whether or not to take inventory out of the numerator? The inventory turnover. If your inventory is not turning over quickly, you better check the quick ratio. And then Murphy's Law, you can sell it, and when you do sell it, you sell it to somebody who can't pay you on time. Well, if your inventory is not turning over and neither are your receivables, chances are you're going away, but then you should rely on the cash ratio. Okay, now accounts receivable turnover. Can our customers pay us? Or are we writing it off? What's the ability to turn over those accounts receivable into cash? What's the collectability of those credit sales? Now, your numerator's your sales per the income statement, your denominator's the balance sheet. So we're mixing. So we got to make sure the denominator, if possible, is an average, okay? So your sales divided by your average accounts receivable. Now, this is heavily dependent on how strict or lax your credit policy is, all righty? But as a general rule of thumb, the more your accounts receivable can turn over, then you got no problems collecting from your customers, okay? Just make sure that denominator's decreasing because you're collecting and not writing it off. So we want to be mindful of write-offs because that will decrease your denominator, and that's misleading. We want to make sure the write-offs are within a relative, a reasonable level relative to prior years and the industry standard. So 5.22, is that good or bad? I don't know, but I want it to be greater than or equal to the standard, okay? Because then we have no problem collecting credit sales, okay? Now, in the abstract, the 5.22 isn't so helpful, but when you could convert this into days, how many days on average does it take you to collect? That gives you more meaningful information, right? So your numerator, take a look, is ending accounts receivable per your current year balance sheet. Now, we want that number to go down because we want to collect. Your denominator is your average daily sale divided by 365, your average daily sales, okay? So ending accounts receivable divided by your average daily, and that should be credit sales, all right? So that's the number of days it takes to collect. So hopefully we can collect quickly without upsetting our customers. Now, 60 looks pretty high, but it all depends upon what the standard is in that industry. All right, so 60, we hope that's less than or equal to the standard. That would mean our accounts receivable are liquid. We're able to create cash quickly. That reduces the risk of short-term distress. If your receivables are not turning over and it's taking you longer to collect, the number of days to collect is going up, that's bad news. Higher risk of short-term distress. Okay, now, obviously you want to collect quickly, but step number one is to sell quickly. So our ability to turn our inventory over into sales revenue. Now, the matching principle. When the inventory is sold, it becomes cost of goods sold. So I'm not saying we want high cost of goods sold in terms of we pay our vendors a lot. I want my inventory coming off the balance sheet onto the income statement, creating revenue. And if your selling price is greater than your cost, you got a profit. You're happy. So your numerators from the income statement, current year cost of goods sold divided by average inventory, because that's coming from the balance sheet. Inventory turnover is heavily dependent upon the demand for your product, your competition, your selling price, your credit policy. But hopefully that inventory turnover is greater than or equal to historical performance or industry average, okay? If it's greater than or equal to the standard, we've got no problem selling. No loss in demand, no unnecessary surplus, that's good. Now, the higher your turnover, the more quickly you're going to sell it. How do we turn that into days? Your numerator's ending inventory divided by, again, average daily, but this is average daily cost of goods sold, not average daily sales, average daily cost of goods sold. Take your cost of goods sold divided by 365. So ending inventory per your balance sheet current year divided by your average daily cost of goods sold. The lower your number of days to sell, you have no problem selling it. So I want that to be less than or equal to the standard. That means inventory is liquid. But be careful. If it's very high, that's easy. If it's taking you much longer to sell, you either got a surplus or you lost demand or your selling price is too high. Something happened. If it's going up and up and it's taking you longer to sell, you either produce too much, you got a surplus, or you're losing demand, market share. But on the flip side, you don't want to sell too quickly either, When you're really below the industry standard, what if everyone else is taking 300 days to sell and you're selling in 100 days? Well, maybe you have a shortage and you didn't produce enough inventory. Or maybe your selling price is too low and your margins are much lower than everybody else. So we want to be in and around the standard. I want to collect quickly, maybe a little bit faster, but not too much faster that I'm pushing my customers too hard to pay me right away. I'll lose sales in the future. Same thing with inventory. I want to sell quickly, but I don't want to give it away either. Okay? So you got to make sure we're in and around the standard, preferably a little bit better. All right, accounts payable turnover. Now, this one's a little bit different. You don't want to pay too quickly. You want to take full advantage of an interest-free grace period. If you're given 30 days to pay, take the 30. It's interest-free loan. If they give you 60, take the 60. Pretty much the only time you'd want to pay quickly is if you're offered a discount, the old 210 net 30. If they give you the opportunity to take a 2% discount, if you pay within 10 days, it's too expensive not to do that. Then you would want to pay and then take the full 10. Now, don't pay in 8. Pay in 10 to take the 2% discount. And if you're not going to pay in 10 days, then you better make sure you don't pay until the 30th day. All right? Why would you pay on the 11th day? That's ridiculous. Then you might as well take the full 30. So how do we do accounts payable turnover? Your numerator's income statement, cost of goods sold. Your denominator's average, per the balance sheet, average accounts payable. Now, this is counterintuitive. I don't want to pay it too quickly. I don't want it to turn over too quickly. So I want that to be less than or equal to the standard. Take full advantage of the interest-free grace period. Stretch it out. Now, 7.27 means nothing unless you have a standard by which to compare it. And you want to be real close to the standard, okay? Now, converting that to days. On average, how many days does it take you to pay? So it's your ending accounts payable per the current year balance sheet divided by, again, second time you're seeing this, your average daily cost of goods sold. Cost of goods sold divided by 365. Again, counterintuitive. Stretch it out. Now, I have a bar above my up arrow because I don't want to incur penalties, late fees, or any of that stuff, but take the full 30. All right? So again, here in this example, we're paying our bills in 54.75 days. I don't know. Is that approximately the standard? Did they give me 60 days to pay? Because I'd rather pay on the 59th. If they gave me 50 days to pay, I'd be upset. We're late. That could negatively affect our credit rating. So if it's too low and you're paying your bills too quickly, that's poor cash management. Or maybe you accepted a discount. Like normally when a company pays and you see it's less than 10 days, there's probably a discount being offered. Now, the danger is when it's too high. It's above whatever the grace period is. If you're given 50 days to pay and you're paying in 54, if God forbid you're given 40 days to pay and you're paying in 54, when it's too high, you're having difficulty paying on time. That's a major red flag. What's going on? Okay, your ability to generate cash from your core business. We love the cash conversion cycle because it's not skewed by methods of accounting or estimates. All right? So we want our cash conversion cycle to be less than or equal to the standard. We want to sell quickly without giving it away. We want to collect quickly without upsetting our customers. The sum of those two, the number of days to sell plus the number of days to collect in whatever order you want, those two, that's your operating cycle. Okay, we want that to be less than or equal to the standard. Remember, we want the optimal credit policy. All right, that'll reduce your operating cycle. If it's too strict, your credit policy, you'll sell slow, although you collect faster. If your credit policy is too lax, yeah, you'll sell real quick, but then you're going to have problems collecting. So the optimal credit policy reduces the operating cycle. And then we subtract from that the number of days to repay the vendor. And remember, we want to subtract a high number. We want to stretch it out, take full advantage of the interest-free grace period, but don't be late. No late fees, no penalties. So where do we want our net operating cycle to be? Add two low numbers, then subtract a relatively high number. We want our cash conversion cycle, also known as the net operating cycle, to be less than or equal to the standard. We want to see it going down. If the trend is going down, it's improving. If the trend is going up, it's deteriorating. But it's all relative to the industry standard. Okay, now, how did management decide to raise their capital? What combination of debt and equity? Solvency is your long-term risk, looks at your capital structure. Okay, now there are advantages and disadvantages to having various ratios, various debt to equity percentages. Okay, in the real world, the amount of financial leverage is really dependent upon the degree of operating leverage. Rarely do you want to combine high operating risk and high financial risk. That could run the company into bankruptcy. So if the company has a low degree of operating leverage, they don't have a lot of fixed operating costs, you have the ability to take on more financial risk. But if you're in a capital intensive industry and you already have really high fixed costs, you probably don't want a lot of financial risk, a lot of interest payments that are legally required. So debt to equity is dependent upon degree of financial leverage, and the financial risk management is not only able to assume, but they're willing to assume, all righty? Now, here the company's debt to equity in year 2, 0.91. Last year was 1.04. So look, there's pros and cons. Debt to equity went down relative to last year. Risk is going down, so we're more solvent. From a risk standpoint, we're improving. But remember, there are pros and cons, okay? If your debt were to go up and your equity goes down, relatively speaking, yeah, there's greater risk. But less equity in the denominator, higher return on equity. Less partners, higher earnings per share. So pros and cons. But from a risk standpoint, there's no doubt. Higher debt to equity, you're assuming more risk. When you have a lower debt to equity, like in this example, it's going down. Yeah, you have lower risk. But folks, when equity goes up, full picture, yeah, now you're going to have a lower return on equity. And with more partners, you're going to have a lower earnings per share, right? Risk and reward go hand in hand. Okay, now, more solvency ratios, your total debt ratio. Okay, when you look at your debt relative to your assets, your liabilities relative to your assets, again, both from the balance sheet, no averaging requiring. So when you have lower liabilities, when the ratio goes down, from a risk standpoint, you're improving. When the ratio goes up, risk is going up, it's deteriorating. All righty, so in our example, last year the debt ratio was 50, now it's 47. Well, it's improving a little bit. Okay, but remember, the downside of less debt and more equity, lower return. All righty, we talked about the equity multiplier before, that degree of financial leverage that amplifies the risk assumed as well as that return on equity. Your equity multiplier is also known as DFL, degree of financial leverage. Why is that important? Important? Where's my accent from? Minnesota. Return on asset times degree of financial leverage. The higher your degree of financial leverage, the higher the risk, but the higher your potential return on equity. The lower your return on asset times a lower degree of financial leverage, well, the good news is less risk. Bad news is a lower return on equity. All right, so in this example, the year 2 degree of financial leverage, it went down a little bit. It was 2, now it's only 1.91, so lower risk. By the way, there's 2 ways of calculating that degree of financial leverage. No averaging required. Total assets divided by total equity, or 1 plus your debt divided by your equity. Same result, different format. Okay, I just want to illustrate the importance of financial leverage for a second. Let's say on day 1 you buy a stock for 50. The next day you flip it and sell it for 100. It doubles in value. What's our return on the asset? 100 minus 50, your profit, divided by the cost, 50, 100%. You doubled your money. You're very happy. But what's your return on equity? I don't know until you tell me how I financed the acquisition of that $50 stock. Let's say you took $25, you borrowed $25 out of your own pocket. Now your numerator, selling price minus cost minus the interest expense on the loan, but it's only 1 day, so we're going to make that a 0. It's negligible. Your numerator, your profit is still 50, but now you're dividing that not by your asset of 50, but your equity of 25. What's your return on equity? 200%. So the return on asset, you doubled it because your degree of financial leverage was 2. When you take the asset 50, you divide it by the equity 25, your degree of financial leverage is 2. You amplify the return on asset by taking on financial risk and borrowing half the proceeds to buy that asset. Now, this works both ways though. Remember, degree of financial leverage amplifies. Good news becomes great news, but bad news becomes awful news. What if our return on asset were a negative 25%? Well, even though the return on asset is a negative 25, your return on equity is going to be what? A negative 50. So it doubles whatever happens to the return on asset, good news or bad news. Okay, another way of assessing solvency, do you have enough operating profit to pay your interest as it becomes due? It's called your interest coverage ratio or times interest earned. Again, anytime a coverage ratio goes up, your risk goes down. So in your numerator is EBIT. The earnings before interest and tax, which is what you have available to cover the interest expense. Both from the income statement, no averaging required. The higher the coverage ratio, the lower the risk. So EBIT divided by interest expense. Now, remember, there's good news and bad news. As you have a much higher times interest earned ratio, well, that's probably because you have very little interest expense, right? If you have very little interest expense, then you probably have very little debt. If you have very little debt, you probably have a lot more equity. So the pro is, yeah, from a risk standpoint, there's lower risk, but with more equity in the denominator, you're going to have a lower return on equity, right? No free lunch. That's what we call it, right? No free lunch. I like the free lunch. All right. So again, a lot here. If you want to stop and do some multiple choice, great. And then I'll see you back. Otherwise, come back one more video and we'll bang out the rest of the ratios. See you back in a second.